Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy. The ticker is DBMF. We've titled this monthly update 50-30-20, What Goes in the 20, as the industry and portfolios are seeing a continued shift toward an evolution of the traditional 60-40 model. And this, of course, begs the question, what should go into the 20% allocation? Assumedly, this alternatives allocation includes ingredients that are uncorrelated with stocks and bonds, but also may deliver alpha, risk mitigation, diversification characteristics, and absolute long-term performance. Of course, we believe a critical building block for that 20, and one of the truest of alternatives, is managed futures, and we believe DBMF is an optimal solution for that asset class. Going forward, we're going to be touching on this 50-30-20 asset allocation question more and more, especially the 20 part in our research and messaging, and Andrew will touch on it briefly today, alongside our regular update on performance, attribution, and positioning with some color points along the way. So with that, Andrew, I hand it over to you.
Thank you, Mike. And as always, thanks to everyone for listening in. In May, DBMF declined around 1% and remains up 15.7% net on a price basis year to date. As noted in the second bullet, we got some favorable inflation data, which caused a burst of risk-on enthusiasm, and hence both stocks and bonds once again bounced in tandem. By month end, the S&P 500 was up 11.2% year to date, while the Bloomberg US Aggregate Bond Index remains down a disappointing minus 1.6% this year. Probably the most important statistic not on this page is that through the first 5 months of this year, DBMF is approximately 600 basis points ahead of the SocGen CTA index, here and after the hedge fund index, and over 700 basis points ahead of the Morningstar US Trend Systematic category, here and after the Morningstar category. So this is actually within expectations. As we talked about last year, there is noise in replication that generally cancels out over time. And when it does, fee and expense savings drive outperformance relative to hedge funds. Last year, we had a few things go against us in the same year, what I called flipping tails several times in a row. It's unusual, but it can happen. This year, our outperformance is attributable to both fee savings and the hedge funds flipping tails a few times in a row. Next month, we'll talk about this in some detail, but it's worth noting that predictions last year that pre-fee replication had somehow stopped working were, shall we say, simply wrong. On the contribution front, May was a little bit like the flip side of April. Modest losses in currencies, commodities, and rates were not quite offset by the gains in equities. On the positioning front, after putting on some aggressive trades in the first quarter, which generally worked, we've seen a dialing back of risk as the second quarter has evolved. And this also is to be expected. We want the portfolios to be dynamic, to hunt for new opportunities, to hold trades when they're working and pivot out as market conditions change. The world looked very different in April than it did in March. Next slide, please. Here's the same chart we introduced last month on stocks, bonds, and DBMF, except with year-to-date and not inception-to-date performance. That one is next. DBMF, of course, is the top line. We had a great first quarter in April and then gave back a little in May. The drumbeat here at DBI has been and will continue to be that managed futures potentially is a highly valuable diversifier to stocks and bonds, not just in difficult years like 2022, but across a market cycle. From my perch, it's, shall we say, heartwarming to see the strategy outperforming equities and bonds in a year that has been decidedly risk-on. Periods like this hopefully will put an end to some myths about the space, such as you should only own it if you think we're on the cusp of another crisis. Next slide, please. Which of course brings us to our regular chart on stocks, bonds, and DBMF since inception. DBMF has returned around 10% on a price basis per annum, with a negative correlation to both stocks and bonds and over 1,000 basis points per annum of annualized of alpha to equities. To put that in perspective, according to data that we pulled from Bloomberg, most liquid alternative funds have delivered zero or negative alpha to the S&P 500 over the same period of time, with roughly double the fees. As we and others have discussed, and as Mike alluded to, 60-40 is going through a grinding transition to 50-30-20. The challenge is what to put in the 20. The two obvious questions allocators are asking today are what strategy has a low correlation to both stocks and bonds, now that stocks and bonds are moving in tandem, and B, what helped the most in 2022. The answer to those questions beats a path to managed futures. Now, given far better products than a decade ago, plus growing sophistication among allocators, such as how to avoid the big landmines in the space, our guess is that managed futures will be 3 to 5% of that 20% over the next several years. Now, we're doing work with others to see what others would think will fill that bucket, and we're happy to share that with you once we have that research available. So here's our slide on volatility adjusted positioning. The red dots are from the end of 1Q and the green dots are from today. The big theme has been a dialing back of risk after trade started to reverse in April, most notably a drop in long equity exposure, the euro short, and crude oil long. From here, current positioning looks pretty balanced, actually. Modest long equity exposure to participate in risk-on markets, coupled with positions that could benefit from an unexpected resurgence in inflation, like long crude oil, gold, long the US dollar versus the yen, and short treasuries. That combination has resulted in 3 to 4% of gains at the portfolio level this quarter, while sidestepping the extreme ups and downs of equities, as we saw a few charts ago. So let's hope that continues. Which brings us to the next slide. Here is contribution by factor. As noted last month, the winners and losers will change month to month. Through the first 5 months of the year, the clear and consistent winner has been the Japanese yen. In early May, there was a bit of a panic as the Bank of Japan intervened in the market, yet by month end, the yen was back down to roughly where it started the month. So to me, this highlights a strength of medium to long-term trend following. In any long-term move, there will be all sorts of head fakes along the way. I've described those head fakes as like turbulence on a plane. A 100-foot drop feels like 1,000 feet when you're living through it. So human traders are prone to panic. And in fact, shorter-term trend models can also look a little bit like human traders. So after a few bad days early in the month, we held the yen position. It resumed its decline, and we recovered losses. The next biggest category of gains this year has been in equities, where we dialed up equity exposure and captured much of the 1Q gains. Gold and treasuries have also helped us as well. So with that, I'll pass the baton back to Mike.
Thanks, Andrew. So let's wrap here, as we always do, with some long-term performance comps. Year to date, 2024 through May, DBMF, despite a slightly negative month, actually expanded its outperformance against its key benchmarks a bit, as those two benchmarks fared worse. So DBMF is now ahead of the SocGen CTA index by over 245 basis points annualized, and ahead of the Morningstar systematic trend average by over 440 basis points annualized. And of course, our expenses, which are less than half of that of the Morningstar peer group, represent another compelling differentiating factor for DBMF. So with that, in closing, thanks as always to our clients, to our prospective clients, for your confidence and for your interest in DBMF. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.